Welcome to Odisal Associates, Accounting and Finance Tutors. We are continuing our lectures on business combination. That is concepts in business combination. We have looked at reacquired rights. We have looked at indemnification asset. We have looked at contingent liability. We have looked at contingent consideration. We are going to look at reverse acquisition under Ifrs 3, business combination. Reverse acquisition is defined as occurring when the entity that issues securities, that is the legal acquirer, is identified as the accounting acquiree, and the entity whose equity interests are acquired, the legal acquiree, is identified as the accounting acquirer. Now, we want to look at some concepts that we have there. One, we have legal acquirer, and then legal acquiree. Then the legal acquiree is known as accounting acquirer. In a reverse acquisition, it's a situation where legally a company acquires another company. But the company that they acquire is supposed to be the acquiree. But at the end, it becomes the acquirer. So that's why we have what is called legal acquiree. That's the person, the company that actually issued shares or security in order to acquire the other company. Then the acquiree, the legal acquiree, is the company that was acquired by the legal acquirer. However, it turns out to be that the legal acquiree happens to become the accounting acquirer. Most of this time, this kind of acquisition often arises when a private company operating seeks to fast track their public listing of their shares. So most of the time you see that it will look like the company that is being acquired is an ordinary share company that is formed or established just to acquire the other company. Now, when we are talking about reverse acquisition, we should look at the concept of substance over form. Substance over form is such that transactions are accounted for based on who is getting the economic benefits, who derives the economic benefits, rather than the legal form of that contract. So in a reverse acquisition, you will find out that at the end of the day, the acquiree gains control of the acquirer. Ordinarily, the acquirer was supposed to gain control of the acquiree. But in this case, the acquiree gains control of the acquirer. Legally, the acquirer is known to be the parent of the acquiree, while the acquiree is the subsidiary. So we have also what is called legal parent and legal subsidiary. These terms need to be explained for you to understand. The legal parent is the same as the legal acquirer, and the legal subsidiary is the same as the legal acquiree. The legal subsidiary becomes the accounting parent, because in consolidation, even though it's going to be consolidated in the name of the legal parent, but it is the legal subsidiary that will be used to consolidate in the parent. That is why it is called reverse acquisition. Now let's take a simple example. Let's assume company A is the legal acquirer of company B. And then company A has a total of 1,000 ordinary shares, while company B has a total of, this is A, this is B, a total of 500 ordinary shares. And then for company A to acquire company B, company A issues 3 shares to acquire 1 share of company B. 3 units of shares to acquire 1 share of company B. In such a situation, company A is going to issue, because company B has 500 shares, is going to issue 500 times 3. That will be 1,500 shares. That's what company A will issue. If company A has issued 1,500 shares, what it means is that the share value or the unit of shares of company A will be 1,000 plus 1,500, which is 2,500 shares. In this situation, you will see that B now is having 1,500 shares as against 1,000 shares that A has. This company now, A, will now have a total of 1,500 shares. So if you look at the percentage of B's holding in A, it will be 1,500 over 2,500 times 100 over 1. This will give you 60%. What it means is that B is holding 60% of A's shares. That makes them automatically having control over A and becomes the parent. However, in the eyes of the law, B is still seen as the subsidiary, while A is seen as the acquirer or the parent. So in such a situation, we say that the acquisition is a reverse acquisition, where the acquirer becomes the acquiree. So we are going to be looking at legal parent, legal subsidiary, legal acquirer, legal acquiree. How do we identify the accounting acquirer or the accounting parents? These are some indications, some key indications that we can look at. 1. Former shareholders of the legal subsidiary retain or receive the largest portion of voting rights in the combined entity. As we know that corporate governance deals with democracy, so majority carries the vote. So if the legal subsidiary has more voting power or rights in the legal parent, automatically you have seen that a reverse acquisition has taking place because it is the subsidiary that will hold sway, the legal parent. Another way to identify is by size, the relative size of the acquirer, legal acquirer, and legal acquiree. Size, we look at assets, we look at revenue, we look at profits. If these things, assets, revenues, and profits of the legal subsidiary is significantly greater than that of the legal parent, then you know that a reverse acquisition has taken place. Then again, when former owners or managers of the legal subsidiary dominate the composition of the governing body or senior management of the combined entity, reverse acquisition has taken place. How do we treat reverse acquisition in IFRS 3? Financial statements. Financial statements are issued in the name of the legal parent, but are a continuation of the financial statements of the legal subsidiary. So it is the accounting acquirer that actually issues the financial statement, even though it's in the name of the legal parent. But however, it is not as simple as that, because some cases you get the structure of the legal parent, and then some cases you get directly from the legal subsidiary. Consideration transferred. Consideration transferred are measured as the fair value of the number of equity interests the legal subsidiary would have had to issue to give the owners of the legal parent the same percentage equity interest in the combined entity. Now, when a reverse acquisition takes place, what it means is that the legal subsidiary will, accounting-wise, issue shares to the legal parents to acquire the legal parents accounting-wise. And in issuing that share, the legal subsidiary will ensure that the percentage holding in the parent will still remain the same when he issued that shares. So in this circumstance, the legal subsidiary is having 60% of the legal parent shares. So when he is issuing that shares, accounting wise, he must make sure that the share is going to issue will be such that his position in the parents will not either be diluted or increased, but will remain the same. Goodwill calculation. Based on the difference between the consideration transferred and the fair value of the identifiable net asset of legal parent, that is accounting acquiree. This is how we base the goodwill. Consolidation procedures. Assets and liabilities recognize the identifiable assets and liabilities of the legal parent at fair value. So we know that assets and liabilities must be recognized as at fair value. This is the normal rule for consolidation. Equity structure. The equity structure in reverse acquisition reflect the equity structure of the legal parent, including the effective instrument issued to effect the business combination. So this we must be very, very careful in this place. We are going to look at the equity that was issued to reflect or to affect the business combination. But however, we are also going to consider the equity of the parent, the legal parent. That's what is going to guide the ordinary shares that we're going to show there. Then we also have to look at the total money that was realized from the issuing of the equity, retained earnings, and other equity balances. Those of the legal subsidiary accounting acquirer prior to the business combination must be the one that will be brought in to consolidation. Disclosure requirements. Nature and purpose of the business combination. Identification of accounting acquirer and acquiree. This is one important thing that the acquisition method says we must do. We must identify who is the acquirer and who is the acquiree. This is because in some situations, the acquirer becomes acquiree. Description of how the reverse acquisition was accounted for and information about the consideration transferred and the amount of goodwill recognized. So we have looked at this. We have just stated the requirements of the standard concerning reverse acquisition. A situation where the acquirer becomes the acquiree. Then we are going to look at an illustration question to be able to understand it better. On September 30th, 2024, Entity A publicly listed shell company with minimum operations, acquires all the equity interests of Entity B, a private operating company, by issuing 150 ordinary shares. Now, the data of the companies are as follows. Entity A, legal parent, accounting acquiree. Entity B, legal subsidiary, accounting acquirer. Current assets for Entity A, 500 naira. Non-current assets for Company A, 1,300 naira. Total assets for Company A, 1,800 naira. Current liabilities, 300 naira. Non-current liabilities, 400 naira. Total liabilities, 700 naira. Retained earnings, 800 naira. Issued equity, 100 ordinary shares, 300 naira. Net assets, 1,100 naira. Then Entity B, legal subsidiary. Current asset, 700 naira. Non-current asset, 3,000 naira. Total assets, 3,700 naira. Current liabilities, 600 naira. Non-current liabilities, 1,100 naira. Total liabilities, 1,700 naira. Retained earnings, 1,400 naira. 60 ordinary shares, 600 naira. Net assets, 2,000 naira. Additional information. Entity A issues 150 ordinary shares to acquire all 60 shares of Entity B. Fair value per share, Entity A, 16 naira. Entity B, 40 naira. Post-acquisition, Entity B's shareholders own 60% of the combined entity. Fair value of Entity A's non-current asset is 1,500 naira. So in this case now, we need to see how we can account for the business combination. The first thing we need to do is to identify the acquirer. Despite entity A being the legal acquirer, entity B is the accounting acquirer because one, entity B's shareholders hold the majority shares of entity A. That is 60% of the combined entity's voting rights. Two, entity B's management dominates the combined entity. And three, entity B's operations are significantly larger than entities A. This aligns with IFRS 3, measurement of consideration transfer. Under IFRS 3, the consideration transferred is measured as if entity B had issued shares to acquire entity A. That's why I said that entity B, the legal acquiree, will issue shares to the legal acquirer in the proportion of his holding in the legal acquirer's equity. So in this case, what it means is that since the legal acquiree has 60% of the legal acquirer, and the legal acquiree has 60 shares, 60 units of shares, he has to issue additional 40 units of shares to the legal acquirers in order to continue to maintain his 60% in the legal acquirer's equity. Because in this case, we have the legal acquiree has 60 shares, and then he issues 40 shares. That will be 100 shares. So what it means is that he still retains the 60%. Now, the 40 shares that he's going to issue, he's going to issue it at the market price of the legal acquiree's shares. In the question, they said that company B, that is a legal subsidiary that has turned accounting parent, has that his share value is 40 naira. So he's going to issue that 40 shares at 40 naira. So it will be 40 naira times 40, which will give us 1,600 naira. So this becomes the consideration that is transferred. Fair value of net asset acquired. So let's look at the fair value of net asset acquired. Now, you know that it is company B that is now acquiring company A in accounting form. So it is the net asset of company A that will be acquired by company B. So we can look at it this way. Company A's current assets in the question is 500 naira. And the question said that there was a change in the non-current assets. So the non-current asset becomes 1,500. 1,500. Because we are going to account for it using the fair value. The fair value of the non-current asset is 1,500. So the total assets is now 2,000. Then we also need to value the liabilities. There was no change in the liabilities. Liabilities, we have current liabilities 300 naira and non-current liabilities 400 naira. Which will give you 700 naira. Then net assets will be 2,000 minus 700, which will give you 1,300. Then goodwill calculation. We have already confirmed that the consideration transferred was 1,600. So it will be consideration transferred 1,600. And then we have net asset 1,300. So goodwill will be 300. That's goodwill computed. So after this, we have actually done the things that we need to do in order to bring about the consolidated financial statement. So we are going to draw the consolidated statement of financial position post-acquisition. Post-acquisition. Of course, we will lay it down the way it is. We'll start with current assets. We're going to add the B and A current asset. We'll add the B and A non-current asset. And then we'll bring in the goodwill to have the total assets. Current assets. B plus A. This current asset is 500. B current asset is 700 according to the question, and A is 500. So the total current asset will be 1,200. Then non-current asset. B plus A. B non-current asset is 3,000, while A non-current asset is 1,500. 3,000 plus 1,500 equal to 4,500. And then the goodwill is 300. Goodwill, as we calculated before, 300. So we have a total of 6,000. Total assets. 6,000. Then we look at the current liabilities. Just the same thing we did here. Current liability B plus A. Non-current liabilities B plus A. The current liability for B is 600, while that of A is 300. 600 plus 300, that's 900. The one for the non-current liabilities for B is 1,100, while that one for A is 400. Then if you add it up, you have 2,400. This is total liabilities. Okay, we also have to work out the equity. Now, the ordinary shares now will increase by the amount of shares that was issued by the acquiring company. Ordinary shares. It was A that issued 150 shares. Initially, they had 100 shares and they issued additional 150 shares. The nominal value of that share was 3 naira. I hope you will understand how we got the 3 naira, because in the question it is said that they issued 100 shares and the value of that 100 shares was 300 naira. So like we learned when we are doing ratio that when you have the value and the uh, unit of shares, that you divide the value by the unit of shares to get the price of shares. So that's how we got the 3 naira. So that will give us 7 naira, 750 naira. Now we want to, the share we issued, we had a consideration of 1,600, right? Remember that we said that this will also include the share that was issued, that was bought over by A, which is 600,000 naira. So if you add 600,000 naira, that's the share of B, the share that was issued by A in order to acquire B. That was the value was 600,000. So if you add it, you have 2,200. So this is the total amount as the equity realized in the issue of shares. What you will have to do now, since this is the total and you have already removed 750 naira as the ordinary shares, the remaining of it will now be share premium. So if you remove 750 here, you have 1,450. 1,450. So this will be regarded as share premium. So share premium 1,450. Then we also learned that you are going to use the retained earnings of the acquired subsidiary that has become parent. So that will be B's retained earnings. Retained earnings. It is the B's retained earnings that we are going to use, 1,400. So this will give you 3,600. Then total equity and liability. That will be 6,000 naira. So your account has balance. Presentation and disclosure. Equity structure reflects entity A's legal capital structure. That's why we did 100 plus 150 to have 750 naira. Retained earnings. It is the retained earnings of B that is used, the accounting acquirer, which is this 1,400 that we use. Goodwill recognized was 300. That is this 300. That's the goodwill that we recognize. Disclosures include details of reverse acquisition, identification of accounting acquirer, and the basis for measuring consideration transferred. This illustration demonstrates the accounting treatment for a reverse acquisition under IFRS 3, highlighting the identification of accounting acquirer, measurement of consideration, recognition of goodwill, and presentation in the consolidated financial statements. It's important for us to note this, that identification of the acquirer is key to solving the question. And again, we should know at what point we should use the legal acquirer's structure and at what point we use the legal acquiree structure. We have seen that the legal acquiree has become the accounting acquirer. In such a situation, the legal acquiree that is now the parent accounting-wide will issue shares in proportion to their holding in that legal acquirers in order to do the consolidation. So we have seen that the current assets, we combine them. The non-current assets, we combine them. And the goodwill as computed using the consideration that was realized by the issuing of the shares of the legal subsidiary. And then the net asset of the legal parent, because it's assumed that the legal subsidiary has acquired the legal parent accounting-wise. That's how we computed the goodwill. Then the current liabilities, we merged, combined that of parent and that of subsidiary. The non-current liabilities, we also did the same thing. And then when we came to equity, we used the structure of the legal acquirer. And then the structure of the legal acquirer is what we use to reflect the ordinary shares. And we now use the difference as premium, share premium, considering the amount realized from the new share that was issued, and then the value of the legal acquiree's shares. That's why we added 600 to 1,600 to get 2,200 naira, and then removing this share value. And then we only use the retained earnings of the legal acquiree, and we have a balanced account. So this is a question on reverse acquisition. Well solved for you to understand. I'm going to give you an exercise for you also to look at. Solve it in the comment section. Later, when I've seen your performance, I will come and I will give you the model answer. Exercise. Practice this question to see if you understood the topic. Presented below are the statements of financial position of John PLC and James Limited as at 31st May 2022. So we have the column for John PLC, and we have the column for James PLC. Then it's in thousands. Non-current assets. John PLC 7.3, James PLC 12 million. Current assets. John PLC 4.5, James PLC 7.7. Total assets. John PLC 11.8, James PLC 19.7. Equities and liabilities. 1 million ordinary shares at 1 million naira each. For John PLC, 1 million naira. 600,000 ordinary shares at 2 naira each for James PLC 1.2 million. Retained earnings, John PLC 7.8, James PLC 10.2. Total equity 8.8 for John, 11.4 for James. Non-current liabilities 1.6 for John, 4.8 for James. Current liabilities 1.4 for John, 3.5 for James. Total liabilities 3 million for John, 8.3 million for James. Total equities and liabilities 11.8 for John, 19.7 for James. The following additional information is relevant to the acquisition. 1. On the 31st of May 2022, John PLC acquired 100% equity interest in James Limited. The consideration for the acquisition is in exchange of 2.5 ordinary shares in John PLC for every share acquired in James Limited. 2. The fair value of each ordinary share of James Limited at this date is 40 naira per share. The quoted market value of John PLC ordinary shares was 6 naira per share as at that date. 3. The fair value of non-current assets of John PLC changed to 11.5 billion. Except this, there is no change in the fair value of the net assets. Required. Identify the acquirer and the acquiree. That's 1. 2. Compute the fair value of consideration transferred. 3. Compute the goodwill. 4. Prepare the consolidated statement of financial position as at 31st May 2022. Solve this exercise. Post it in the comment section. I'm going to look at it. If you make any mistake, I'll correct it. But later, I will give the model answer to the exercise. This is where we have come to an end of this episode. We have looked at reverse acquisition as is accounted for in Ifrs 3, business combination. It's a very interesting topic where the acquirer becomes the acquiree and the acquiree becomes the acquirer. We looked at the legal acquirer and the legal acquirees. We look at the legal parent and the legal subsidiary. Then we look at the accounting parent, accounting subsidiary, accounting acquirer, accounting acquiree. These are concepts that might be confusing, so you have to familiarize yourself with them when you are treating reverse acquisition. Yes, this is Odisal. We will continue to teach and enlighten students, not only students, even those who want to revise what they have done before. You may have forgotten some things you did in accounting, and this is an opportunity for you to go back and look at them. You are also allowed to criticize us. Send your comments. We will respond to everything that you commented on. Continue to follow us as you watch our videos. More videos will come. More topical topics will come. Thank you for following us.